Well, in other streaming news here, a top streaming executive at Disney taking the reins at popular social media app TikTok. Kevin Mayer, who led Disney's streaming efforts, will leave his post at the House of Mouse, becoming the new CEO of TikTok. Mayer will also serve as a chief operating officer of TikTok's parent company, ByteDance. The short form video app has exploded in popularity recently as Americans are confined to their homes amid the pandemic. The app saw roughly 11 million new users in March alone, twice the total in December. Joining me now is Frank Curzio, analyst at Curzio Research. Frank, great to have you here with me today. Let's start with the Disney side of this. What does Kevin Mayer's departure mean for the company?
For Disney, first, thank you so much for having me on. But for Disney, you could say it's not so much of a surprise because he did get passed over for the top job. But I think you could see a lot more departures at Disney because their revenues are coming lower. The coronavirus is really hitting them hard. You're talking about theaters, Broadway, cruises, hitting them across the board, where it's not going to be something short term and a quick rebound. So with Kevin May leaving, I think in terms of Disney, kind of expected, but you might see even more executive departures because as you're seeing earnings decline, it's very hard. To pay these people as executive bonuses and things like that. And a lot of executives being in this industry 25 years, a lot of it is tied to greed. So for him going to TikTok, I think is a very, very good move. And because it's one of the fastest growing companies, I would say out of any company in S&P 500, maybe.
Yeah, to that point on potentially seeing more executive departures, which kind of segments within Disney or even other big tech companies might you see these moves to these more nascent platforms like, say, a TikTok?
Well, it is a good question, right? I mean, this is a person that Kevin Mayer came from streaming, and streaming is supposed to be their prized asset, even though it's a very, very, very tough business. It's great for people like you, for me, to watch all these things for $5, $6, $7, and maybe a little bit more for premium channels, but it really is a tough business. I mean, Netflix, you're looking at a company that's paying $17 billion for new content. And even your guest before this talked about how Apple is actually starting to pay for that content too. This is a business that's built on new content. And Disney just got in at the exact wrong time, pre-coronavirus, spending $70 billion on Fox Entertainment assets. So they have lots of debt payments coming up. They have about 45 billion in net debt, and with all these employees furloughed, over 100,000, you could see executive departures in Parks division. They just reshuffled a lot of their divisions, but it is going to be interesting to see. But it's not going to be too easy not too difficult to get some of their top executives out of there to leading competitors that have that recurring revenue stream, right? Which Disney doesn't have, and that's why they were trying to do streaming. But they just did it at the really wrong time, and they took on a lot of debt. And now earnings are supposed to decline significantly, not just for this year, but also next year as well.
Yeah, you mentioned debt and increasing costs. Let's talk about Disney streaming specifically. The company, of course,
Mhm.
already has this vast existing library, but does
Yeah.
plan to spend billions more on new content. What does Disney have to do to extract value from its streaming service?
Yeah, it's an industry where almost nobody makes money on. I mean, you could say Netflix makes money, but they're negative cash flow. So right now, if you're looking at Netflix, they have 180 million users compared to 50 million for Disney, and they're spending 17 billion. The models right now that you have out, which are given by Disney and the sell side analysts that are covering the JP Morgan's, Goldman Sachs, and things like that, you're looking at they have 50 million subscribers now. At 150 million, they're looking at in about 3 to 4 years, and they're suggesting they're only going to pay 5 billion, which is definitely not going to be enough for new content. So the amount of money that has to go into new content, and that's the key to this. I mean, you have a lot of people on the platform, but how long are they going to continue to watch the same Disney movies, right? I mean, I sell subscriptions to Curzio Research. If I keep giving them the same content, they're not going to subscribe anymore. So I think that's a big factor in the competing with the Apples, the Netflixes, which have really good balance sheets and tons of money, billions to spend on this new content. Where Disney's raising money in the debt markets, they just suspended the dividend for 6 months. They're probably gonna have to do it for the year. They're in a much different boat, so it's going to be interesting to see if a lot of free subscribers that came onto Disney, which is at the beginning through T-Mobile and I think it was through T-Mobile or Verizon, if they continue to stay on, if you're not having that new content that the Netflix have, which is constant every month.
And beyond streaming, the pain for Disney could last a while. In the parks division specifically, they are going to
Hmm.
slowly reopen, but with a lot of additional rules. In what
Yep.
segment to that point do you expect the company to be investing in the most, where kind of that mix of what had previously been their shiny object, the parts division, now is going to face a lot of pain?
I think they're going to continue to invest in streaming because that's the growth model pre-coronavirus, right? And that's what you want to see with these companies. You want to see, that growth model is which gives them the premium. The thing is, when you don't have earnings growing, this is a company of the past 5 years that traded 25 times forward earnings, and it was trading at that high multiple, higher than 19 times forward earnings pre-coronavirus, because there was so much optimism around streaming. Now that the coronavirus hit, and you're not seeing that revenue come in and those earnings come in, that cash flow come in from the other divisions, it's going to be real difficult because if you're looking at parks, 80% is going to be the new 100% capacity, right? Just from the distance, you don't have the land. And I would guess, this is a pure guess, that with Disney, I would say 70% capacity is their break even. So their new capacity is going to be 80, 85%. So those margins are going to be down, which means what? They're going to have to raise prices, right? To try to get pricing power, which I'm not too sure if they're going to do, where middle America and that middle income, so those families that love going, that's where you're seeing the most trouble in this economy right now. So it's a tough situation. The stock is trading at a very, very expensive valuation. It could decline 25% from here, and it'd still be one of the most expensive stocks in a Dow next to Boeing. So that's how expensive it is right here. A lot of expectations are built in.
Yeah, on the point of TikTok now, let's touch on that
Hmm.
before I let you go. There was concern about data privacy from a lot of lawmakers because of its ownership by Chinese company ByteDance. Is that something that you think Kevin Mayer is going to have to tackle head on first and foremost?
I think he is, but this isn't like your typical where a lot of China companies where you see, like Luckin Coffee, right, turn out to be a fraud. This is a company that's valued. I mean, it was valued at $80 billion in 2018 in the last capital raise, where big heavyweights, KKR, SoftBank came in. So TikTok is part of ByteDance, right, which is a China-based company. And if they really have problems with this, I think it's good that these problems are coming up now before they place an IPO, and they're able to deal with it. It's going to be very, very good for the company. And if it's that much of a problem, because we know that China-U.S. relations are heated up right now, they could spin this off. And you have, SoftBank, KKR, especially SoftBank, right? So you're looking at an Asian-based company that is in Alibaba, that's in T-Mobile, Uber. So they understand how to spin this out if they needed to, because they have 500 million users just in the U.S. alone, 800 million users worldwide. It's pretty incredible to see the growth of this company. So they'll figure it out on the privacy issues, but it is a little bit of a headwind. But again, it's good to have this now and really deal with it, because once you solve this and really come public, it's going to be like a Facebook, Instagram. This is an industry that commands a very, very high multiple, and I could see 120 billion-dollar valuation, which is probably within a top 15% of S&P 500 companies based on market cap.
Wow, really great context and insight. Frank, thank you for your time. That's Frank Curzio, analyst at Curzio Research. Appreciate it.